The world lit up. Anna Wong, with legit cred out of Lucas's Chicago, was fiery. The news conference was rich in philosophy, process, and institutional aspirations, but poor in operational guidance. The absence of Clarida-like analytical specificity appears to have spoken louder than Warsh's words. So Lucas did what he did. CGG, Clarida, Ghali, and Gertner reinvented modern economics with something called dynamic stochastic general equilibrium theory. We come out now, and as Claudia Sam says, we have a chairman who's not sure what he's looking at in inflation. How does he get the rails back on? Does he need to reaffirm PCE is the inflation series?
Well, I think what he said at the press conference is for now until next January at least. That's going to be
correct.
The Fed adopted that again in January. He left open the possibility that the task forces could recommend other measures. They could go to an average. Instead of picking one index, they could look at CPI, PPI. There are a lot of things they could do. But I think Anna, as usual, raises an important point, is that an inflation targeting central bank needs to be clear about what it is it's targeting. It can and may evolve. And so I think that will be important.
Very, very importantly then here, if we need to get the system back with a confidence about the Fed, how does he do that at Jackson Hole? Does he have to reaffirm, as Sam says, that inflation is the appropriate measurement and not a policy?
Well, I think Jackson Hole may serve a couple of purposes. Historically, as we've seen, chairs have used Jackson Hole as sort of a sneak preview of coming attractions at the September, November, and December meetings. Chairman Warsh hinted he may do that. He's also interested in what he called some big picture questions that he sort of previewed at this meeting. And he's also talking to the task forces. So I think it's too early to tell what he'll do at Jackson Hole, but he may do that as well.
I find it really interesting that he doesn't want to tell the bond market a whole lot of things, and he's kind of waiting to take his cue from the bond market. From a layperson's point of view, it feels very circular, right? The central bank sets a benchmark interest rate, the bond market takes its cue from that. What's the rationale for the Fed to take its cue from the bond market that's relying on the Fed to set policy? Help me understand that.
So here's the way I would express it. The Fed is a very important part of 10-year Treasury yield. It's not the only thing that drives yield. So I think the chairman was important to emphasize that the Fed does want to step back and interpret movements in bond yields. It could be inflation, it could be global growth, Middle East hostilities. But certainly the chairman and the Fed understands that an important part of 10-year yields is the expected path of the funds rate. And to Scarlett's point, and Ben Bernanke gave a speech on this, as did I as vice chair. It's sometimes called the Hall of Mirrors problem in central banking, which is the central bank looks at the market looks at the central bank, it can get circular.
Let's go back to your paper. Ghali and Gertler didn't know this. Richard Clarida channeling Alan Blinder. Having looked at monetary policy from Joni Mitchell's Both Sides Now, I can testify that central banking in practice is as much an art as a science. How does Warsh get back to science, to Clarida silence, versus some mom and pop philosophy he learned at Stanford?
Oh, well, I think Kevin Warsh and the committee understand that. Look, Chairman Warsh came in with an ambitious agenda. And I think that they're going to both focus on implementing that agenda as well as getting to where they need to be on policy. I guess where I would try to relate Clarida, Ghali, Gertler to the current conversation is perhaps specifically in the domain of forward guidance. And so in the CGG model, there's actually not a role for forward guidance because the market understands the Fed's reaction function and the Fed understands the market. If you're not going to do forward guidance, then it's incumbent for the markets to have a broad understanding of how the central bank will react to data. If we had 6 bad months in a row of inflation data, would they hike and by how much? They're not committing to that, but they're saying if the data comes out this way.
For everybody on Bloomberg Money and Scarlet, I got goosebumps. This is like the real deal. I mean, this is what the adults in the room are arguing about